Thank you very much for having me here in Australia. I'm thrilled to be here today to address you. It's really surreal in some ways. I've been involved in alternative lending now since 2007, and this conference very much reminds me of some of the early conferences we had in the US as that sector was getting off the ground there. So I'm very optimistic and excited for what's to come in Australia. Maybe before we get into this, I'd love to just get a sense of who's in the audience. So you just raise your hand. How many folks here are with alternative lending platforms in one form or another? And yes, I see a bunch of OnDeck people there. Awesome. And how many folks are with banks? Great. That is very different than the US in 2007. So you guys are much further ahead, I think, than the bankers were on the other side of the world. And maybe investors in alternative loans? A few, okay, that's important. We'll need those. Great. So we'll start, really by just sort of talking about three things today. We'll talk about the opportunity, why SME lending makes total sense here in Australia. We think the conditions are ripe to build a really robust SME lending market here in this country. A little bit about OnDeck, who is OnDeck and what are we really bringing to the market? And then this idea of what are the ingredients for success. Having watched the market evolve in the US and the UK, here in Australia, what do we actually need to put together, really with the folks in this room will be integral in making this market successful over the next 5, 10, 20 years. So why does online SME lending make sense in Australia? And the first, let's just set up why it makes sense kind of everywhere. And Australian small businesses are not much different than small businesses all around the world. They need capital to grow. Right, and that's where businesses are very different than consumers. Consumers do make investments from time to time. They invest in education, they invest in their homes, but a lot of consumer debt funds lifestyle purchases, whether it's funding clothing and food, or whether it's funding a vacation or what have you. It's not necessarily aimed at a long-term return on investment, but in SME lending, businesses all the time are making investments in growth. When you buy inventory, you expect to sell that inventory through within 6 to 12 months. When you acquire customers, the payback on those customers can be measured usually in months, maybe a couple years. There's always a need to manage cash flow as a small business owner. Often you are paying your variable costs, you're paying your employees, you're paying your suppliers before you get paid by your customers. And hiring workers. In the US, 38% of businesses hire seasonal workers sometime during the year. So there are all these investments business owners want to make, and all these investments require usually external capital. But the challenge is that finding business credit is a problem. And there's a number of really interesting kind of structural reasons why. So as OnDeck prepared to go international, we actually had small business owners apply for credit in a whole bunch of different countries around the world. And what stood out was not how different the experiences were, but how similar. In a number of these countries, you saw wait times of 60 days, typically, to take a loan from the initial application or inquiry all the way through to funding. So it's a time-consuming offline process. And when you talk to small business owners, the most scarce resource they have is their time. These folks are cook, chief, and bottle washer for their business. They have so much to do. Time is very, very valuable to them. Then you have the issue of the non-tailored credit assessment. What most small business lending looks like when you peel back under the hood, so to speak, is consumer lending. Many banks, at least in the US and I believe around the world as well, tend to focus on the personal credit score of the business owner, which actually doesn't contain any useful information about how that business is doing. There are false positives and false negatives. I might be great at paying my mortgage and my auto loans on time, but I could be terrible at running my restaurant. Or conversely, I might use personal credit to get my restaurant off the ground, and just when I have an attractive business that needs capital to grow, I look like an overburdened consumer because that consumer credit score doesn't take into account the performance of my business. Then you have an issue with product mismatch and collateral. There are actually bank lending products in the US where to borrow $100,000, you have to place $100,000 in a bank account. So fully collateralized on day one with hard cash. And so business owners logically ask themselves the question, if I have $100,000 to put in the bank account, why would I bother getting a loan? So that is what we see. Rigid collateral requirements is a way of equalizing the risk in small business lending, and the product mismatch gets to those use cases I talked about on the prior slide. These episodic investments business owners make don't typically require capital for 4 or 5 or 7 or 10 years. They typically require capital for 1 or 2 years, but the traditional bank loan products usually focus on, in the US at least, 3 to 5 year loans, which are not matched up to the use cases business owners have. So we'd like to introduce you to a customer of ours here in Australia, Dave Anthony, and he typifies this small business lending conundrum. So Dave is a plumber, and he wanted to invest in his business to grow from doing not just plumbing, but adding sort of carpentry and remodeling and other services to his business. He had a long-term relationship with his bank, multi-year relationship with his bank, and so logically he thought, maybe I should go to my bank to get a loan because I've had my deposits there for such a long time. And what he was told is that not only would it take a lot of time and effort, a lot of documentation, multiple visits to the branch, in the end, unless Dave fully collateralized that loan, he was not going to get a loan from the bank. So that really typifies the problem that small business owners face. Traditional loans are onerous, and as I believe David mentioned at the start, that sort of self-selects business owners out of applying for capital. And we saw this very much in the US. What I think alternative SME finance is competing against in some ways is not the banks, it's inertia. It's small business owners are so discouraged by the traditional process of applying for capital, they sit on the sidelines, and they choose not to make growth investments in their business. And in Australia, this is the same thing. 60% of Australian businesses say they need finance, but only 20% apply. That 40% gap is only there because this is a notoriously inefficient market. And when you look at Australian lending to small businesses, it's only grown by 2% CAGR in the last 4 years. In the US, online lending grew 68% last year. And we'll talk about this a little bit more at the end, but there really is an economic development story here. The more we can make access to capital frictionless for small business owners, the faster the economy ultimately will grow. So why is SME lending hard? It's not that banks don't want to lend to small business. It's not that other institutions, there's a lot of micro lenders out there, there's a lot of government funds allocated towards small business loans, but there are real challenges in SME lending that make it different from consumers. And the first is around diversity. So you can see this is 3 businesses from our platform, a restaurant, a landscaper, and a plumbing company, have very, very different revenue and cash flow patterns. The restaurant has steady cash flow through the year, the landscaper looks very different in summer versus winter, and the plumber's revenue is erratic. Sometimes they're doing break, fix, or repair revenue, but sometimes they're staffed on subcontracting jobs and they have revenue spikes. And so the way most traditional lenders handle that diversity in SMEs is by manual underwriting. A human being sits there and reviews the plumber, the landscaper, and the restaurant manually, builds a cash flow model, makes a determination of debt service, and then allocates a loan offer. That process works for a $1 million loan or a $2 million loan, but for a $20,000 loan, a $50,000 loan, it's just not cost effective. Then you couple it with technology and data limitations. Data on small businesses is very uneven, to put it mildly. Small businesses are always being created, they're always being destroyed, so they're much more transient than consumer identities. If you think about yourself as a consumer credit profile, you have one profile in your entire life that follows you. But when you're a small business owner, you might start multiple businesses in your life. You may have multiple jobs in your life. And so there's a dynamism in small business lending that's very, very different than consumer. And the data that's available on the current state of small business out there is much more spotty. So that also makes it challenging for traditional lenders. And then finally, there's a lack of a standardized small business credit score. So the FICO score in the US is the gold standard for personal credit. There are equivalents or similar models to the FICO score around the world, but the small business credit side has been much murkier, much harder to decompose, if you will, into a simple score that's universal that everyone adheres to. So for traditional lenders, the diversity, the manual process, the data limitations, and the lack of an easy score to go to make these lending decisions result in a lack of capital flowing to small business. So let's talk about the size of the market. In the US, there's 28 million small businesses, and we estimate about $250 billion of opportunity in terms of the SME lending opportunity for alternatives. And the opportunity comes from 2 places. One, the $186 billion that represent the existing lines of credit and loans from banks to SMEs. But more importantly, in some ways, there's that $100 billion of opportunity that comes from the unmet demand in the market. Because the search cost in this market is so high, a lot of the capital that could be flowing to small businesses is not. And that $100 billion is a greenfield space that alternative lenders are now filling in. And it's not just true in the US, but it's true globally. So the global SME lending opportunity, $14 to $18 trillion to SMEs, 125 to 150 million SME units, if you will, in the world. And this is an interesting stat. 50% of SMEs have no overdraft capabilities, but would like one. And that's a very important thing. The volatility in SME cash flow is high. And the need for even shorter term credit from banks and other institutions to help them bridge those cash flow issues is a universal issue. There's an estimate now, $2.4 trillion in unmet credit demand globally for SMEs. So it's a massive market opportunity. And here in Australia, it's a very sizable opportunity on its own. So China, we think, is the dominating size of market, if you will, in the world. The US, you see, at kind of that $250 billion level. But here in Australia, depending on the estimates, there's a $95 billion estimate, which I believe is Morgan Stanley. Then you have a $70 billion estimate from Macquarie. But either way, those are very sizable market opportunities that now you'll see a rush of entrants, including OnDeck, coming in to fill. So with that, I'd like to transition a little bit and tell you a little bit about OnDeck. And we actually started lending in Australia about 3 months ago, and what we believe we're bringing to the Australian market. And I promise I'll go through the commercial pretty quickly to get to a little bit of the market opportunity and what needs to happen to our ecosystem here in Australia to develop a robust market over the next 5 to 10 years. So OnDeck is the leading online platform for small business lending. We've provided over $4 billion now to small businesses in the US, Canada, and now Australia. We're growing very, very fast, even as we scale up the company in terms of size, 62% year-over-year originations growth, triple-digit net revenue growth, and we've served over 45,000 unique SMEs. 2 points that I'll come back to a little bit later. We're on our 5th generation credit score. So remember how I said there was no widely accepted credit score for small businesses? We've created something called the OnDeck Score. We believe it's the most predictive scoring system now for small businesses in the US, and now we've extended the score and adapted it to Australia and to Canada. And one other thing to keep in mind, once someone tries a loan from an online lender like OnDeck, they usually don't want to go back to the old way. And that's so true for so many areas of our life. If you think about the way you probably bought a plane ticket 20 years ago, the way you search for real estate, if you want to rent an apartment or buy a house, all of those search processes have gotten way more efficient through online technology, and lending is no different. So once a business owner knows that capital can be, minutes or hours away through an online process, they always want to come back to that process in subsequent times they access capital. It's been a long, strange trip, to quote the Grateful Dead. We started the business back in 2006, 2007, and really it was a crazy time to start a lending business because the world, I think over here you call it the global financial crisis, the GFC, happened in 2008, 2009. So we started at the end of the last credit boom. We immediately went through the credit bust. It probably set us back about 18 months in terms of our development, but we also learned a lot of lessons about how our business would perform during a recession, which I think serve us very well in the discipline that we bring to the company today. And then we started to scale up the business, and particularly in the last few years, I think it took us 6 years and 7 months to get to our first $1 billion of loan volume. It took us about 5 months to go from $3 billion of volume to $4 billion of volume. So the company has been growing quite exponentially. And I think a couple notable points about our development. When we started the company, as I mentioned, banks were very skeptical and almost unaware of the idea that you could get small business loans online. We think now, though, that this industry is going more mainstream, and it was evidenced recently in the US. We signed an agreement with JP Chase, which is one of the largest banks in the US, to power their online small business lending operation. And so just to give you a sense, JP Morgan does about 10 times the volume we do in small business loans, yet they saw enough value in our platform to choose us to power their online lending. And then here in Australia, we partnered with the CBA, which we're very excited about, to work with their customers as well for fast, efficient online small business loans. So I think the fact that you see now banks recognizing the value in these platforms and partnering with them shows that this industry's time has arrived. So what do we believe we're bringing to the Australian market? 3 things. First is our SME credit solution. We have a technology platform and a set of products that are built end-to-end to serve the needs of a small business owner. The second is our expertise in data and credit scoring. So we think we have the leading SME credit score, and we've adapted that here for the Australian market. And then finally, scale. One thing I've learned in the last 8 or 9 years is that lending is an exercise in scale. The benefits in some ways accrue disproportionately to the scale players. You learn more the more you lend. You can attract more capital at better and more favorable terms. You can market to your customers more efficiently. And we can actually bring some of those scale advantages to Australia on day one, so to speak, in that business, which I think ultimately benefits the Australian customer because they have access to better products and a better process much earlier than they might have if a large global player weren't in the market. So our solution for small business loans, instead of this offline process where a business owner might spend 33 hours of their time searching for capital, you can go online, you can be approved for a smaller loan in minutes. We can actually approve loans of up to $500,000 now in the US within several business hours. You can have a very quick review, and then you can fund as fast as the same day. So most business owners actually don't need money the same day, to be clear, but what they also don't want to do is wait 6 or 8 weeks. So we believe we're about as fast as the market needs us to be at this point, and it's a much more streamlined process for customers. Here in Australia, our initial product is a term loan solution that ranges anywhere from 6 to 24 months. And sizes from $10,000 at the low end up to $150,000 at the high end. And the typical use cases for our product are true in all of our markets. Buying inventory is the #1 use case. So you're a retailer. The more working capital you have access to, you can actually stock up for Christmas. You can sell more through and make a higher profit for yourself. But if you don't have access to the working capital, you can't make that investment on the margin. Hiring new staff, as I mentioned earlier, and marketing. We also pioneered something in the US, which we're bringing to our other markets around the world, around how businesses pay us back. So small businesses do have volatile cash flow, and many of them cash flow very regularly, though. And so what we pioneered was automatic daily or weekly payments from a small business owner. The automatic part makes it very easy for a small business owner to handle. They kind of mentally budget for how much that payment is and kind of leave that amount of money in their bank account. And from a lender's perspective, it gives us an amazing kind of early warning system on our portfolio that's very different than a traditional bank loan. So in a traditional bank process where you might wait 30 or 60 days before you would notice if a customer's delinquent, at OnDeck we track delinquencies down to the day level. We literally have a 1-day past due metric in our portfolio, and that allows us to react very quickly if changes are going on in the market or in the broader economy. So that was the solution. Our OnDeck Score, it's on its 5th generation, and without getting too much into detail here, we track about 10 million small businesses in a proprietary database that we've built. We've integrated now with over 100 electronic data sources to feed the OnDeck Score and to collect data on small business owners. And when a business owner applies, we collect about 2,000 data points on every loan application. So it's a very robust system. And at a high level, I think what's important to just take away on this is when you decision a small business loan, it's very different, again, than a consumer loan in that when a consumer loan, you might use the same criteria on every application to approve loans. So you might look at someone's personal credit score, do they own their home, their annual income, have they ever filed bankruptcy? In a small business situation, if you think about it, in a given moment, you might have a business that's 2 years old who has no credit track record applying for a loan. And then a minute later, you have a business that's 20 years old applying for a loan. And the data footprints on those two businesses are completely different. So what I think is very unique about our scoring system is we make the best decision we can with the data we have available. And that's a very different approach to lending than a traditional approach. And if we're not as confident about the decision, our loan offers and terms come down commensurately. The more confident we are, the more data we have access to, we can go the other way. What is important about the OnDeck Score, it sounds cool, but what does it really mean in practice? What it means is this curve on the left shows you, and I won't get into it in too much detail, but for the same level of risk, let's say you're trying to target a 10% default rate, or you eliminate 90% of the defaults, that horizontal line at the top of the chart there. What we're basically able to prove empirically is that with OnDeck scoring system, you can approve twice as many customers as a personal credit scoring approach on its own. And that blue curve, which represents the OnDeck score, over the years keeps bending up and to the left. So as we improve the scoring, we can actually serve more customers every year for the same level of risk than we did the year before. And that's an important part of, I think, why we exist and what our position is in the market. A little bit on scale quickly. Reaching scale is not easy. There are 4 variable costs in SME lending that are important to think about. One is acquisition. Acquiring small business customers is challenging, and I'll talk about that in a couple more slides. But small business owners, they don't necessarily go to trade shows. They're extremely busy running their business. They don't often know their neighbors down the street. The optometrist at one end of the street doesn't know the restaurant owner at the other. So you need a lot of different ways to reach out to small businesses, and that improves with scale. Processing and servicing. So the more data you collect, the better your decisions are, the better you can negotiate with the data vendors. So you get some vendor costs down as you scale, and you automate more of your processes. So you get benefits there in terms of the scale of the business. On the capital side, everything's cheaper when you buy in bulk. So if you're borrowing $500 million from the capital markets to make loans, you'll probably get better pricing than if you're borrowing $5. And then on the credit side, as we mentioned before, the more loans you make, the more data you collect, the better your credit models become. And for us, there was a real inflection point at the $1 billion mark. When we had loaned about $1 billion, our credit models started to get a lot more predictive. So there are real advantages on credit scoring that come with scale as well. So the solution, the scoring, and the scale, we believe that's what we're bringing to Australia as we enter the market. And it takes a long time to build these things. So nearly 10 years. We made our first loan in August of 2007, $5,000 to an auto body shop outside of Connecticut, in Connecticut, New York. Outside of New York, in Connecticut. That's the jet lag talking. And today we've loaned over $4 billion, but you can see it was really on the last 3 to 4 years where, as I said, the score got more predictive, the scale effects really started to kick in into the business, and we made a lot of progress. So that's a little bit about OnDeck. And now as we look to Australia, how might the Australian market develop? What are the ingredients for success here? What do we all need to think about collectively as a group to make sure that there's a robust, dynamic Australian small business financing market in 5 or 10 years? So we saw the US market follow 3 phases. Low awareness, followed by skepticism, followed by what I would call the stampede. And just to give you a sense of this, in 2010, there were approximately 10 alternative lenders marketing to small businesses, 10 unique companies. By 2015, that number was approximately 60. So people perceive a space and a market opportunity, they flood in. Over time, what we believe is that by 2020, there will have to be some amount of attrition or consolidation. As I mentioned, all of the benefits in this technology or in this market accrue to the scale players. And for some of the subscale players, they'll have more challenges in a down cycle, in a recession, and there'll be a culling out likely at some point. So that's the US, but if you look at that time frame, 2007 sort of starting out at OnDeck, 2017 is just a year away. It's probably 15 years before the market kind of matures end to end, so call it 2020. What we think is interesting about Australia is we think it can all happen faster. What I've been amazed by as I talk to our folks here in Australia who have been on the front lines for the last couple months as we've gotten our business off the ground is just how low the awareness is among Australian business owners of this type of financing. So we are definitely in this low awareness phase right now here in 2016. But you guys have a more concentrated market. My understanding is that in things like job search or real estate, you wind up with 2 to 3 scale players in each of those markets. Rather than having 20 or 30 players in the market. So we might have a more concentrated market opportunity here to go after that doesn't support as many total companies. You have the early involvement of large players. So we're working with MYOB, the leading accounting software company in Australia. We're working with the CBA, one of the leading banks in Australia. And those types of partners wouldn't have talked to American OnDeck back in 2007. So the fact that big partners recognize the value of this space early is very important, and I think will take years out of the market development cycle here. And you obviously have a positive data and credit environment. There is enough data available on small businesses to run these types of businesses. So you need 3 ecosystems, we think, to grow the market. The first is funding, data and payments, and distribution. Let's talk about funding very quickly. There's 3 types that are important to the development of online SME lenders. The first on the right side is the equity. These companies need to get equity funding to grow. The middle is a robust marketplace for loans, so having loan buyers available who are willing to actually take the credit risk on the loans, purchase loans from these platforms. And then on the left side, as these businesses get more mature, they access typically warehouse facilities from banks, which have an effective cost of capital that's cheaper than the marketplace, but can result in the lenders themselves taking the credit risk as opposed to selling that credit risk off to investors. So the funding ecosystem is going to be critical to develop here in Australia as these platforms need access to capital to grow to serve the market opportunity. Data and payments, so important. I would say the market environment here is very good, but could even be better. So just to give you a simple example, in the US, when you look at a Business Credit Bureau report, you see both positive and negative information. So positive information, the business owner successfully paid a loan back. Negative information, the business owner defaulted on a loan. Here in Australia, the credit bureaus typically traffic in negative information only. So on the plus side, you can identify folks who have had trouble paying back loans in the past, but on the negative side, you can't see the health of some of these businesses in the same way that you do back in the US. So we're optimistic that over the next 3 to 5 years, many of the vendors here will start to add this positive information and really add other forms of data, because as online lenders, we depend on that data to make good decisions. And finally, distribution partners. I've talked to so many people who have built businesses that serve small business over the years, and they all reach out to customers in a very diverse set of ways. So whether it's banks recognizing the potential here, whether it's SME solutions providers like accounting software and payroll companies, merchant referral partners like loan brokers and accountants, or online companies who serve small business, referring customers over. All of these types of partners are going to be critical for online SME lenders to access to grow the opportunity. So I'll close here with a little call to action. So we want to create an ecosystem that works. On the lending side, we'll have emerging and traditional lenders. Ideally, these companies should be working together in harmony and not in conflict. I think the nice thing about SME lending as opposed to consumer lending is that SME lending is generally complementary to what banks have traditionally done. Whereas some of the activity in the consumer space is a little bit more competitive to what banks have traditionally done. But in SME, these two entities can really work together to grow the market. And then the ecosystem. So if you're an investor, raising funds to invest in these platforms, do your diligence. On the platform side, it's incumbent upon us to make good credit decisions. One platform who sort of slips off to the side too much on credit can sort of tamper the market a little bit for all the platforms, so it's important that we continue to lend responsibly. On the data and payments side, we hope that the Australian small business data vendors recognize that alternative lenders are a new source of customers for them. We are one of the biggest consumers of small business credit data in the US now, on par with some of the major banks. So if they invest in this opportunity, on the other side, the lenders will become great customers of their data and payment solutions. And then the partner ecosystem, whether it's banks or non-banks, having folks recognize potential here and work with online lenders. And the result is that we can get industry growth and bring this mainstream. So to sum up, if you take the fintech or lending players, you add the healthy ecosystem, you add the scale, you wind up with economic growth. So to bring it back to Dave, there are 1 million Australian SMEs that are more or less like Dave, and they're starting businesses, they're growing businesses, they're making investments, they're managing day-to-day cash flow. And when you have mass adoption of online SME lending, that gap between the 60% of Australian small business owners that need capital and the 20% who apply, that gap will close over time. And what we found in the US is that for every dollar, it's a truly an incremental dollar of loans going into the economy, it winds up with over $3 or creates over $3 in economic output. And that's the opportunity we believe here in Australia. And thank you very much.